Hello, this is Steve Ginelli, and I'm the host of the inaugural show of the Crowd Caucus. This is a roundtable discussion of a number of thought leaders in the crowd space. We'll be discussing news, events, trends, and forecasts in the crowdfunding community and in the space. I'm pleased to introduce some of my guests this morning or this evening, depending on where you're situated. I've got Jonathan Fruitkin from CrowdFunding. Good morning, Jonathan.
Good morning, Steve.
I've got Barry James all the way from London with the Crowdfund Center. Barry, how are you? Barry, can you hear me? I think we're having a little technical difficulties with Barry. And
I'm good, thank you.
oh, there you go. Thank you. Welcome. And then lastly,
I'm here. I'm hoping you can hear me now.
yes, I can. Thank you. And then we have the publisher of the quotidian Crowdfund Beat, Sydney Armani. Welcome, Sydney.
Thank you, Steve. Good to be here.
As a little bit of a start, again, this is a new program. Hopefully we'll capture some attention of those that are passionate about the crowd space. But as a kickoff, Sydney, maybe you can give our audience a little snippet of some of the current events, some of the current news in the crowdfunding space.
Well, glad to, Steve. Thanks. Well, first, thanks again for inviting me to your program. I'm looking forward to it. You asked us to tell us the news, what is happening, and glad to join your great guest, Barry and Jonathan. They're great in the industry, been in one of the pioneers actually for information. We have a lot of articles of you as well as Jonathan and Barry at the Crowdfund Beat. And so I started with the news this past week that the big news was the fundraise got $31 million. I mean, and that's a lot of enchilada, with a lot of money in news. And they put it again in real estate. Real estate has been very hot the past months. The real estate mogul about a month before it got $9 million. And so I think and Barry can tell more about what's happened in England. It looks like worldwide we see the crowdfunding real estate has been good. So this is one of the news, $31 million. And the other news is that a couple of articles that, Odyssey Airlines is launching public U.S. crowdfunding. The airlines are getting to this crowdfunding. So it's a lot happening. A lot of new players are coming to the market. And Start Citizen is one of the crowdfunding games. I mean, they raised already almost $44 million. So it's a lot of millions, a lot of peer-to-peer. It's been a very good, positive week last week.
Yeah, and in fact, I think our crowd over in Israel just raised $25 million in a B round. So, yeah, I'll echo your view and your perspective that capital is finding a home within a lot of these crowdfunding platforms. That being said, Barry, you just released a superb research piece on the state of the, as you call it, the e-funding industry. And maybe you can share a couple of the findings, particularly those that actually surprised you. Barry, can you hear me?
Yeah, sure. Yeah, very happy to. Very, very happy to. The report called Funding and the State of the Crowdfunding Nation. And as you know, we've analysed thousands, in fact tens of thousands, over 75,000 to see what's happening. And the first surprise is, well, there's no surprise that crowdfund's growing. Everyone kind of knows that, but how and how fast. And we kind of looked at that and we went, how do you capitalize that? How do you capture that? Well, everyone knows how much society and business has been transformed by the computing revolution described by Moore's law, that says that computing power doubles every 2 years, and later on it 18 months. And global crowdfunding, as we've observed over the last 3 months, has grown at a rate consistently doubling every 60 days, which is stunning, and I believe beyond anyone's expectations. So growth rate, rate of sustained growth globally, is the as far as I'm concerned. So that was one surprising thing. I guess the other couple of surprising things. One was the variability. The performance in some categories on some platforms is absolutely anything up to 70% success rates, and in other categories on other platforms, almost zero. 2, 3, 4%. So huge amount of variability, which was slightly surprising. And then, kind of from a UK point of view, it kind of startled us a little bit. The 80%, or very, very nearly 80% of crowdfunding projects in the UK are on platforms outside the UK, principally those in America. Now, a very thriving crowdfunding industry here. We've got, I think it's 97 different crowdfunding platforms here. So that was a surprise for us.
Mm-hmm. I know that you had referenced in your research that the UK is actually growing at a faster clip than the United States. Yeah, what do you think accounts?
Yeah, that's right.
What do you think accounts for the
I think
faster
there's
growth?
2 reasons. Yeah, I 2 reasons. One is crowdfunding's been very much in the news, and start to penetrate into mainstream culture, and I think we're seeing the beginning of that. But also, I think a big chunk of the growth we're seeing here is the growth that's coming from.
Barry, you just muted yourself. Oh, okay.
I think that came from elsewhere. But just to summarise that quickly, I think one is the beginnings of penetration of the mainstream culture. I think the other is the of equity crowdfunding here.
Do you see? I'm curious with the very rapid growth of crowdfunding, and as you mentioned in your research, and there's a number of other research firms that are tracking the same level of growth. And Jonathan, maybe you can chime in here too. Is the growth in crowdfunding, whether it's the perk-based, whether it's security-based, whether it's the peer-to-peer space, is this really a zero-sum game that financing resources are just being redirected into the crowd space from other types of investing activities or practices, or is this a renaissance of new investment activity?
Yeah, it's definitely a little bit of both. I mean, we have, in the U.S., we have an incredible amount of growth in the peer-to-peer space. In the UK, there's a lot more money going into companies, whether it's through debt financing or equity. Part of that's regulatory. But the money itself is expanding, that is going into investment generally. And part of that has to do with improving economies, the lack of return if you put money into government bonds, other things like that. So, look, investors are trying to find opportunity. What the crowdfunding world has done is begun to expand out that opportunity. And I think that it shouldn't be a surprise that we're seeing this kind of incredible exponential growth. And I don't anticipate that'll slow down. In fact, it'll probably accelerate as the regulatory environment in the U.S. in particular begins to slowly become more favorable for companies raising capital and investors looking to participate.
I'm curious, Jonathan, because of your securities law background. Um, there's been attempts in the public markets, such as the AIM market in London, the TSX up in Toronto, their venture exchange, and now the OTC, the over-the-counter market, has its QB, the venture angle. Why would you sense that crowdfunding is growing as quickly as it is when you do have public framework to raise money in the public markets on a small and venture-backed basis?
Well, I think that most of the activity that you're seeing, and Barry could probably talk more directly to this because of his experience, not just studying it, but particularly in the UK and Europe, is that what you are seeing is basically an opening of the world that angels and venture companies had lived in. Really early stage concept companies and sometimes A rounds. And that's something that we see very infrequently on the publicly traded markets, obviously because of the expense. And so I think that in all practical terms, the money that we are seeing that is going in from crowdfunding is kind of even though they're emerging market companies, is still pre-revenue, or at least early revenue expansion capital, rather than long-term liquidity capital, which you get from the various markets.
Mm-hmm. Well, one of the observations, and I'd be curious as to all you gentlemen's perspective, is the demographics of the investor within the crowd space. And I'm not necessarily focused on the perk-based participants, the patrons as I would call them, but rather those individuals that are deploying investment capital. It would seem, at least by my cursory observation, is that there's been a lot of young, the millennials, the 25 to 34-year-olds who, through their own activities in possibly an early stage company, have had a win or a monetization, and because they recognize the risk and return and thereby receiving the return successfully, they're looking to redeploy as opposed to building a sort of a conventional portfolio, investment portfolio. Could you guys comment on the demographics of the participants in the crowd investing space?
I'll defer to Barry to see if he has any actual data, and then I'll throw in my 2 cents, which is backed up by nothing but my own opinion.
Okay. Let me combine this with the answer to the previous question, if I may, in that I am absolutely 100% clear that we're out of the zero-sum game. If you can look research, not so much ours, but the work last year made this very, very clear that the crowdfunding movement globally has the potential to massively increase the amount of available venture capital. So I'm really clear about that. How we're seeing it happening, well, not so much in the peer-to-peer area, where I think, perhaps most of the new capital, not all of it, but most of the new capital is coming from stuff that would have gone in the bank, savings or whatever, into peer-to-peer. But there's some new as well. But crowdfunding is attracting lots of capital for non-traditional reasons. It is about return on investment, but it's also about other things as well. And I'd even venture to suggest that to kind of understand this phenomenon, you've got to look beyond the capital. Capital is important, but actually you've got to look at the entrepreneur's journey, and you've got to look at the entrepreneur's training, and you've got to look at the opportunities, and you've got to look at the way that this bears on and I don't would like to have. I'm going to do lots more research. We're engaging with some of the universities now on this, on the profile of investors, and and the age profile being one of them. But my feeling is that the millennials, those at the end of the scale, are far more turned on, are far more engaged with crowdfunding propositions, because not just of the transparency, but because there's a spark there, that's about the innovation, that's about sometimes the social agenda as well, and the drive to see something happen and make a change to the world and be part of it, I believe is drawing in new capital.
Mm-hmm. And to that point, in terms of the demographic and the ability to bring in new capital, I know prior to going live on the program, we spoke briefly, and Jonathan, I'd love your view in the potential changes in the accredited investor definition. And what do you see there? What do you see in the future? Will that happen? I know from just the history of the SEC, the establishment of accredited investors, which emanated back in the 33 Act, but it wasn't defined at the time. I think it was considered Rule 127, 129, and it wasn't until 1982 that Regulation D was established with the minimum levels of income and net worth. We played, as you remember, when we launched Off-Road Capital in the late 90s, early 2000s. There was conversation at that time, which was literally 17 to 20 years after the establishment or the definition of Reg D, that they were going to shift upwards the income levels and the net worth levels. The only change, of course, has been the exclusion of one's personal residence, the equity in the personal residence, but for the most part, the numbers and the levels have remained the same. Maybe you could comment on what you see from your vantage point.
Well, I really think that there's been a lot of hand-wringing because Dodd-Frank asked the SEC to look at what an accredited investor is. And just so everybody understands, this is a discussion that's been going on now for a few years, so it's not today. But why it's come up more recently is, of course, we have some groups, including the Angel Capital Association, that are actually being proactive to prevent us from having this catastrophic kind of recalibration in just raising levels of what an accredited investor is. So here's what's going on. I'll go back to Barry, and then we can talk a little bit more about accredited. What's going on is you have older people who are in accredited, angel investing groups, older accredited investors who have both experience and capital to put into a company. And then you have younger people who don't really have access to that. And we'll just call this, especially in Northern California in particular, there's a lot of people with a lot of capital and they want to put it into companies. And the idea that it is available online and they can see things online gives them a comfort level that, quite frankly, an older person wouldn't feel in that circumstance. They like to feel paper. They like to physically meet people. They don't like the idea of hanging out on a Google Hangout. And so you're seeing this age shift. And with that comes this redefinition of accredited. And I think the challenge is going to be for people who believe in the free flow of capital, in people more maybe on this hangout, will be the effort not necessarily to raise the level, but to keep it where it is, but also expand it into professionals who might have some knowledge. David Schweikert, who's a congressman from Arizona and led on the Jobs Act with some of the others, he talks about an investment opportunity with something that maybe a chemical engineer would have great knowledge about, but because their income might be below or their net worth might be below, they couldn't invest, while some person who might be older and living on retirement income who happens to have enough in net worth could invest in something they know nothing about. And so I hope that what comes out of the SEC is some sort of combination of figuring out levels of income and net worth, but also including people who might have particularized knowledge, or a financial advisor or somebody who can direct them. So I don't think it's all bad, but I do think it's all interesting.
I get one of the curiosities is the nature or the subject matter of being an accredited investor somewhat arcane, somewhat anachronistic. The purpose of the accredited status was to enable small businesses without the same level of compliance and regulatory submission to raise capital through those investors who had financial means and could afford the losses. And we continue to try to evolve the 33 Act's definition of accredited. Whereas on the flip side of the equation, and I've been exposed recently to some of the public markets, the pink sheets, the over-the-counter market, where every John Q. public can play in these small, these small incipient companies that have a tremendous amount of risk, may or may not have business models, but the public can invest, their $10, $100, $1,000, and there seems to be somewhat of a bifurcated level of responsibility from the SEC, is that you allow small investors to access small public companies with limited reporting and so on and so forth. But then you have, on the flip side, the whole Reg D, crowdfunding, Title III, creating some obstacles in terms of investors being able to access private, allegedly unregistered securities. But for the most part, the risk profile, and I would submit that in the crowd space, with the practices and the disclosures of many of the platforms are providing in terms of description of companies' financials, being able to engage with principals in these companies, that the private markets actually do a much better job in disclosing information. However, the John Q. publics of the world can't access that. I'd be curious as to your thoughts there.
Well, it's unquestionably silly, right? I mean, and we're definitely nearing the end of this era that somehow we're so afraid that people are going to lose their life savings by investing in private companies. And maybe this is best to throw over to Barry. I mean, I anticipate that as things begin to open up here, you're going to see a lot more people who are investing in deals where they not only know the people, but they've done a lot more research than was possible in 1982, right? And so the links between the people and the companies they're investing in and the amount of research, I think, really makes a lot of this super kind of an anachronism that we're going to see disappear in the next few years. But Barry, do you really see what I suspect, which is people who are investing in equity plays in Europe and UK have some sort of connection personally or through a first level connection to either the founders or the product?
Yeah, absolutely. I see very much that we're on the cusp of a big change here. I think it's become irresistibly clear that we're living in a very different world than the 1930s and 40s, where a lot of these trends, rules, frameworks were created and set, which unintentionally, unintended consequences, have created a kind of financial apartheid, where there's those who can participate and those who can't. That has become very controversial. Our terminology is a little different. Our regulator talks about sophisticated investors. We now live in a world where information flows more freely. Crowdfunding in all its forms, and including equity crowdfunding, isn't a world of disclosure where it's a matter of titrating how much you're going to allow people to know. It's a world of openness, and open by default. And just this week, we've seen what I think is is probably the leap forward on all this. We've been saying for some time that you can't regulate this by tweaking and adapting the framework that's there, because it's so different. Because the hyper-connected world is different. These things were created when there was no such thing as Twitter or Facebook or even the web. And 2 years ago, I wrote an article saying our regulator needed to open an innovation unit to help it understand, to help champion and support innovation. And literally last Thursday, the head of our FCA, our regulator, has announced the opening of an innovation unit. And they're saying in set terms